Hey there! Today, we're laying the groundwork by introducing you to the basics of investment vehicles that hedge funds might use. Let's start with the essentials. Stocks or equities represent ownership in a company. When you buy stocks, you're buying a piece of that company. Hedge funds might invest in stocks anticipating their value to rise or fall. Bonds are like IOUs where you lend money to an issuer, like a government or corporation, in return for periodic interest payments and the return of principal at maturity. They're a fixed income investment, providing a steady income stream. Commodities include physical goods like gold, oil, or agricultural products. Hedge funds might trade these to capitalize on price movements due to supply and demand dynamics or geopolitical events. Derivatives derive their value from an underlying asset. Options, futures, and swaps are examples. They can be used for speculation, hedging, or to gain leverage. Equity refers to stock ownership. It's about having a claim on a company's assets and earnings. Hedge funds aim for equity appreciation or dividend income through their stock investments. Fixed income relates to investments that provide a return through fixed periodic payments. Bonds are the classic example, offering stability and income, which hedge funds might use to balance riskier investments. Leverage is using borrowed capital to increase the potential return of an investment. Hedge funds often use leverage to amplify gains, but remember, it also amplifies losses. Short selling is betting on a stock's decline. A hedge fund borrows a stock, sells it, and hopes to buy it back later at a lower price to return to the lender, pocketing the difference. Understanding these basics is crucial for grasping how hedge funds operate. They mix and match these instruments to create strategies that aim for returns in any market condition. See you in the next video where we discuss hedge fund strategies.